Hello and good afternoon. Welcome to the Ringer Plus Show Live, our special segment Ask the Expert Anything. And as you can see, this week we have Azril, who's back for this episode. Right, Azril, how are you?
I'm good, thank you.
I see you're in a new room. Hmm, not bad, not bad. Anyway, sorry. Azril's here and he's going to be talking to us about something that has been worrying a pretty big proportion of investors, right? I think you've all seen the news about one of the biggest companies in the world, not just in China, right? China Evergrande, a property developer who has been struggling to repay its debts, and many people are speculating that it may cost it may cause to an imminent crash in its price. You know, it's we've seen the news as well, Azrael, and I've seen videos where the shareholders are literally saying that they have nothing to live for if the stock if this share price doesn't go anywhere. That's quite scary. So maybe this is a pretty big concern for a wider group of investors as well, because some are speculating that if Evergrande collapses, it may kind of cause like this trigger a global economic crisis or market crash that may be as big as what happened to the Lehman Brothers more than a decade ago, right? So let's start from the beginning, Azril. Maybe you want to share a little bit more about who China Evergrande is and why are so many people concerned about what will happen to the economy or the global economy if something happens to China Evergrande.
Yeah, thanks, Bang, for that. So yes, for those of you in Malaysia, right, you probably have heard of the Evergrande via the news that you have read, but you may not feel it personally to you because it has not affected your life like it has, for example, to Chinese investors or property buyers that have purchased China Evergrande properties, right? So it is one of the largest property developers in the world, certainly the second largest in China, with more than 78 billion in total sales. So in terms of size and scale, you should compare China Evergrande to Petronas, for example, right? Because Petronas and Evergrande are both on the top 100 companies of the world. So
Wow.
in terms of scale, imagine if Petronas collapsed, for example. And in
Yeah.
this instance, it would be China Evergrande. And this is because of the huge debt that they have piled up over the years. And it's a total of 300 billion, which is equivalent to the size of Malaysia's economy
Wow.
today. That's how big it is. And the worrying news has come more so recently, given the mispayments that they have made on their debts. And as a result, the worry that we're seeing in the market is that if they're not able to pay their debts, then they would go into bankruptcy, right? And what that means is that while the company will be valued at zero, so the decline that you're seeing today, for example, on the right-hand side of the chart, 78% decline
78%.
would be close to 100, right? Given a collapse of a company, right? And what we're seeing too is the reluctance from the Chinese government to bail them out, given the high risk that it's posed, and that it is likely to create a moral hazard, right? So the issue with bailout is often when one company is bailed out, other companies think that they can also take additional risk, and as a result would
Yeah.
not be in situation where they might have to close the business. So this is a classic case of too big to fail
Hmm.
example that we've seen in the US with their own crisis that we've seen in 2008. So what does it do, right? So with the imminent collapse of Evergrande, what we're seeing is that this is already affecting the larger components of the real estate market in China, right? So what you see on the top hand side is a decline of 20 over percent since the start of the year. So if you had an exposure in the Chinese property market, you would have already seen these significant decline. And we're seeing that this is also affecting the banking and technology sector in China.
Yeah.
And this is a further decline that we have seen since the start of the year as a result of a margin compression, right? With aggressive bidding of land in China today. So the challenge is, of course, the price is going up, particularly within the major cities and smaller cities in China, and this exacerbate that decline, right? Given the reduction in margin, and also the fact that the government has been tightening, right, in its regulation to ensure
Mm,
that these property developers are not taking excessive debts and also hiking up mortgage rates. So as a result, what we're seeing is a decline in sales too,
yeah,
because more and more people are not able to buy properties given the higher financing costs.
that's
But
a
what
scary
is
situation, eh? To be in as a
absolutely,
property developer.
yes,
That's like compression on
and
both sides.
exactly, and while we do not see the scale that here in Malaysia, of course, versus what we're seeing in China, but we may have experienced it. For those of you that are a bit more older, in the 1997 Asian financial crisis, we saw the same thing, right? When we saw a spike in the OPR from BNM results in higher mortgage rate. So and that makes it a lot more unaffordable. So for those of you that are holding, for example, mortgage at that point would also feel the pain, right? So they may also exacerbate the decline by selling their properties because it no longer makes sense for them to maintain
Yeah,
if they are investors, particularly when the
yeah,
rental is going down. So this can be a ripple effect, right? So we're
yep,
seeing one example of how that could be significant. But what is important to note too is that at this point, based on the data that we're able to see, this is only affecting the real estate market in China, right? So this is illustrated by the yield curve that you see on the left-hand side, where you see comparable companies, right? So Evergrande that you see is the first one. You also see Kaisa Group as well as Sunac Group, where you see an increase in yield. So what this means is typically a reflection of risk. So when you see the price of the bond yield increases, then you should expect that the risk is increasing. But what is interesting is that when you looked at other bond yields for a bank, for example, Bank of Communication on the right-hand side, as well as Lenovo, you don't see such spike. So what that
right.
means is that while the investors within the bond market in China does not see that to be a systemic risk, such that if there's a
Mm,
failure of Evergrande, it will not affect the other companies that are in China that may have direct relationship with the property developer. For sure, a lot of these bankers, for example, are providing loan
yeah,
to these developers, but yet we don't see that resulting in a potential collapse of the banking sector, like what we've seen in the US, where, for example, given the crash of the property market, we saw the collapse of Lehman Brothers, for
yeah,
example, as an investment bank, or Bear Stearns as a result of that failure. So the view that we have at this point is that this is not going to have a spillover effect or systemic effect that will result in one the failure of the banking sector as well as other sectors in China, and also affecting other markets such as the Europe, US, as well as Malaysia's market. Right. So this
right.
is the view that we have today. I mean, of course, this may continue to change. We would see over the next couple of weeks how things are progressing. But certainly at this point, we do not foresee that to be systemic and therefore would not affect our other investments, right? So
Right.
Malaysians primarily have investments in our own real estate in Malaysia, for example, investments in EPF, ASMB, or any other unit trust funds that if are primarily in Malaysia, of course, would not see this impact. But if you have exposure in China, then certainly this you will already be able to see the impact on your investments today.
Yes.
So with that, I think that's a key message. Yeah? And I would like to then, I guess, continue to the next section where we will look at
Yes.
quiz.
Before we go there, we should talk about our quiz. We've been running this for quite a few weeks now. So Azril, I'm sure you know as well that we run the Ringgit Plus Academy, which is a 7-hour workshop for covering all forms. I think basically virtually every aspect of financial management or for personal finance, and we are giving away 5 seats every episode. So for this first section, we're going to give away 3 seats. And remember, these seats, these workshops are it usually cost 700 ringgit. So this is actually a pretty good deal to get them for free. 700 ringgit saved. And in the workshop, we'll figure out what you can do with 700 ringgit, right? So let's go to the question. The first 3 correct answers will receive a free seat to the Ringgit Plus workshop, and our producers in the background and will be contacting you in the comment section. So let's go to the first question. In the event of an Evergrande collapse, is it likely to result in a global financial crisis like the 1997 and 2008? A, true, or B, false? Share them in the comment section below, both in YouTube and Facebook. We are checking both at the same time. Just drop your comments, and we will be giving away, I think in like 10 seconds or 15 seconds, our producers will ping us. But, I think, Azril, you mentioned it just now. I saw it in the slide, the answer. So we will share the answer a little bit, but, I'm waiting for my producers to tell me. 15 seconds has passed, but I think we still have 1 or 2 more seats. So, come on, guys. Maybe Azri, you want to give them a little hint? I saw in your slide just now, you want to just share the slide again, just I think 1 or 2 slides before this, right?
Yeah. Maybe, well, I think it's maybe important to be able to answer these questions to understand how one would define global financial crisis, right? So we would define global financial crisis as a crisis that is not just affecting one country, right? So when it's collapse of, for example, Lehman Brothers that we see in 2008, the ripple effect that we see in Europe as well as the Asia markets, right? So similarly, in 1997, when there was a currency crash started in Thailand, for example, results in a ripple effect, right, to all Asian markets, such as even Malaysia as well, and that would be categorized as global financial crisis.
Right.
So the answer to that is, well, if you think that Evergrande is going to result in a collapse in other markets, for example, then you would think that this is a global financial crisis. But what we're saying earlier already is that we don't think that it might, right? At this point, at least the data point that we've seen so far.
So correct. So the answer is actually false, right? Yes. Yep. Okay. So I saw that slide, so I felt quite confident in saying that it's false. Anyway, so yes, for all the viewers who have submitted their answers, I think our producers will be getting in touch with you at the end of the show. So let's move on, right? The answer here, it's obviously from Azril's our perspective is that the collapse of in the event of an Evergrande collapse, it is not likely to result in a global financial crisis on the same scale as what happened in 2008 and 1997. So let's move on to the next section. And I think this is the one that I think will be more interesting for investors who are already invested in China, right? Let's take a look at the next slide. So,
yep.
We talked about this a few weeks ago as well with the China tech stocks. And like you said just now, there's a slight spillover effect from the panic selling, people who are quite jittery, with the rumors and speculation of a collapse of the one of the biggest companies in the world, right? So, Azril, here's my question: how exactly is it affecting our investments? And then from there, what can we do if we are already invested? And maybe if we're thinking about investing, what is some good ideas and strategies here?
Thanks, Punk. Yeah, unless and only you have bought a property in China, for example, or if you have bought REITs in China, then certainly you would be most affected by this imminent collapse, right? Because of course, like what we've seen in the chart earlier, if you have bought, for example, Evergrande property yourself, you might not even get the property at the end of the day because the companies might not be able to complete the construction of that property that you have bought, right? And number two is that if you had any exposure into any other property stocks or bonds in China, then certainly you will see a decline of 40 to 50% that we saw earlier from a broad market perspective. So those are the major impact that you would see. But majority of Malaysians do not, right, have exposure into it's individual property, unless you're high net worth individuals, that is, right.
Yeah.
For most Ringgit Plus readers specifically, right, we would have exposure from the investments, the digital investments that we have made on two primary platforms. So one is your ETF robo-advisory investments on Stashaway, which has significant exposure into the Chinese tech
Yes,
stocks.
I remember this
So
one.
we heard about the impact of property market, which in theory you would think should not affect tech stocks, but yet we see panic sell off affecting the tech stocks in China as well.
Right.
And if you have unit trust investments that have exposure into China, where typically for Asia Pacific stocks, unit trust, it is typically would have a significant exposure in the Chinese market, right? And the three recommended funds that we have here listed are those with that exposure, right? So this is Principal Greater China Equity Fund, East Spring Investment Dynasty Equity Fund, as well as Afin Huang Select Asia Quantum Fund, right? Although it's important to note that none of these unit trust funds actually have direct exposure into property market in China. But like we've seen, the impact also affects broadly into the banking as well as the tech stocks. So if you look at the top holdings here, so these are primarily actually tech stocks, right? So you see the likes of Alibaba, Tencent, for example, Taiwan SMG, which is the largest semiconductor manufacturers in the world, producing for Apple, for example, would be affected by virtue of sentiment, really, and not fundamentals, right? I think that's the key important thing to know. And specifically, when we looked at KWEB and tech stocks, we've already seen significant decline from the start of the year, right? And this further exacerbate that decline, right? And this is really, to me, a panic sell-off, right? That actually presents a buy-in opportunity for those of you, as per Pang's question, looking to get into the investment space, particularly with tech China exposure, right? So to me, this is actually a good opportunity for you to look at because the price is cheap, right? So you are able to look at buying a tech stock in China at 17 times PE only, which is significantly lower than when you compare global tech PE earning ratio of 40 times, right? So, well, and also when we looked at the broad economics and trends, we don't see that to be affecting the tech stocks. In fact, it is going to be supporting the tech stocks because we see the rise of internet penetration in China, especially in rural areas that do not yet have access to internet. We see digitization of consumption, of course, with 11/11 campaigns, for example, that started off in China. And we see e-commerce sales to continue to increase over time, and that there is a level of support that we're seeing from the government of China too, to actually ensure that the homegrown tech companies, the likes of Alibaba, Tencent, JD.com, would be global champion. Right? And the idea here is that the Chinese government wants them to compete with the global tech companies such as Amazon, Facebook, Microsoft, and Alphabet. Right. So with that, we see this from a long-term perspective would remain to be a very attractive asset classes.
Right.
And when we look at the data too, when it comes to e-commerce sales, for example, in 2014, this is only 10.6% of the total sales. And we've seen that amount doubling, right, to 2020 at 24.9% in total
almost
sales.
2.5. Yeah, it's a lot.
Right. I mean, just across 7 years, and what that amount would have been in 7 years from now, for example. So, and all the companies in these tech companies would have exposure into the likes of Alibaba, right, or JD.com, which is their biggest e-commerce platform in the country. So to me, that actually presents an opportunity for you to invest. And for those of you that that are a bit more risk averse and be thinking, oh, Azril, I'm not sure whether it is good for me to try to time the market, then you can use our long term time proven strategy of dollar cost averaging, which is effectively putting the same amount every month via regular saving plan and ensuring that you're able to buy the unit price of the assets at a lower amount over time on average versus if you had looked to try to time the market. So what is the example here? Maybe I'll show one example, right? So one is if you had put 1,000 ringgit at a price of the asset at 10 ringgit, you would have bought 100 units, right? So when the price goes up to 14 ringgit, for example, with the same 1,000 ringgit, you would only buy 71.43 units. And when the price goes down, for example, in month number 5 to 8 ringgit, you would have bought 125 units. So what do you see here? Well, when the price goes up, you buy less units, and when the price goes down, you buy more units. So what would happen
Right.
if you do this, right? You would actually reduce your average unit cost price. So let's look at one example here. So if you had actually invested into a unit that starts at 10 ringgit, going up and down until it goes back to 10 ringgit, for example. And when you put a lump sum amount of 8,000, you would actually be making 0%, right? Because the 10 ringgit that you put at one time would go back to 10 ringgit. But if you had done a dollar cost averaging strategy, when the price goes up, you buy less unit, and when the price goes down, you buy more units. And as a result, you're able to reduce your average unit cost to 9 and and your return for that strategy would have been 4%. So in this instance, regardless of whether the market goes up and down, you're actually going to benefit over the long term, right? And
Right.
you don't look to time the market, and this is a simple process of just automating deducting a certain amount every month from your account, be it 100 ringgit, 200 ringgit, or even 1,000 ringgit, right? So that's effectively the easy way in which you can try to make money from volatility and continue to invest in the long term.
Right. Cool. Cool. I know you guys have always talked about this for the last I think 6 months that you guys have launched the Ringer Plus Financial Planner Service. It's time trusted, time proven, and it sounds so boring, and yet I think we have countless examples that you have shared with your clients. I remember as well that it works, right? And it's something as simple as that also kind of spreads your risk over time. So yeah, I mean, it sounds like a completely boring strategy, but as we have seen, it's proven to work, and you will see a lot more of these kind of management and investment strategies from the Ringer Plus Academy as well as the Ringer Plus Financial Service, right? So before we go, I think we reached the end of this discussion, right? Yeah. So before we go on to the Q&A, I think there's quite a few guys. I've seen quite a few questions already. Before we go there, we'll go to the last section or last Q&A. The last quiz, where we're giving away another 2 seats for Ringgit Plus Academy, where it is worth 700 ringgit. It's a 7-hour workshop for all forms of personal financial management, right? It's really a lot. So without further ado, I will go to the question. The first 2 correct answers, yeah. Should investors maintain either DCA, maintain via DCA, or increase their exposure into the Chinese market if he or she believes that the market will rebound? A, true, or B, false? So this comes down to conviction, right? That you're confident that this is a short-term correction, and in the long run, it is going to continue an upward trajectory. So send your questions in the comment section. We have 15 seconds. Azril, I know you mentioned quite a lot about this, and I know that you have mentioned a lot, and there's a lot of conviction on your side on the Chinese tech sector, especially, and it's not exactly incorrect, right? I think we've seen so much influence even in Malaysia, right? Like we're preparing in a few days' time. There's going to be not 9/9, not 11/11, but 10/10. And two of our biggest e-commerce players are actually have significant stakes from the Chinese tech sector, right?
Yeah, yeah, and we're not saying. I think maybe there could be confusion around. You should put all your investments into China. Expensive. No, right? This is actually a portion of your portfolio, then certainly the exposure should also be in Malaysia. And to a large extent, actually, most Malaysians already have exposure into the Malaysian market. When you buy your property in Malaysia, you are actually having an exposure into Malaysia. And when
Yep.
you have your EPF deduction,
EPF.
you
Yeah. Yeah.
have a significant exposure in Malaysia, right? So this is a way in which you can actually generate higher return over time, right? Beyond what you have gotten from your property investments, for example, or your EPF or other investments in Malaysia. So yeah, I think this is something that we from Malaysia's market perspective will not be able to see, right? The scale that we see in China is 1.3 to 1.4 billion bigger than Malaysia at 30 million, for example. So that's the scale and the consumer power that China has. So and we're not saying that you should put 100% of your asset into China.
Correct.
It's just a question of
Diversification is the other strategy that you guys always talk about.
yes, and also very boring. Everyone thinks what as your diversification, it's sexier if I put everything into one basket, for example, of China exposure or one crypto exposure, for example, because what you see in the news is the story of people making 1 million, for example, from the crypto investment, one crypto investment. But what you don't see is an aspect of survivorship bias, right? Which is a big portion
True.
of well, that actually have failed but have not been covered by the news. So
Because it's
that's
not
also
interesting, right?
yes. So if you have conviction in China, well, to go back to this question again,
Yep.
you would want to maintain right your exposure and also increase if you believe that the price is going to go up, because the more you buy at this point when the price is cheap, the more you're going to be able to make over the long term.
Potential growth is it's much bigger, right? As I mentioned, I think I saw in your slide just now as well, short-term gain for long-term gains, right? Short-term pain, sorry, short-term pain for long-term gain. And then we're talking about a much longer investment horizon, right? So obviously to answer this question, if he or she believes that the market will rebound, it makes sense to maintain or increase their exposure. So that's the answer is A. I think our producers also mentioned that the winners have already been contacted. So we will go to the last section, which is the Q&A. I think we've got quite a number of questions. So let's get to it. First question for Azril. If I'm a long-term investor, which is with a 20 to 30-year time horizon, that's very long, who does monthly dollar cost averaging, how worried should I be about this situation?
This probably is a avid follower of Ringgit Plus, because we talked about investing for 20 to 30 years time, and some of the unique rules that we introduced called Rule 50-20 and Rule 20-30 to allow for people to reach R1 million in 20 to 30 years time by investing in 9% return, right? So if you are an investor that is looking at it from a long-term perspective, then of course this is going to be a short blip in your investment horizon. And what your monthly dollar cost averaging is going to do is that at this point, you're going to be able to buy more units than you would when the price goes up. So I wouldn't be so worried. In fact, I would actually top up a little bit more to enable me to increase my exposure when the price is cheap. Right? So absolutely the right strategy to do is to keep doing dollar cost averaging, or to add a little bit more if you're willing to take a little bit more risk.
Right. Cool. Why is this such a big deal?
That's such a big question, right? Well, it is a big deal because it is a big company, right? So we've talked about the scale earlier already. And we've talked about the debt size, right? The scale of a Petronas and the debt size that is close to Malaysia's GDP, right? So imagine Malaysia as a country collapse, right? For example, that would be a big deal, I assume, to the rest of the world. So similar to this Evergrande company, right? That just shows how big China is as an economy versus Malaysia, right? And hence, one company has such a big impact to the global market because once they fail, then all those guys that have been lending to them, right, and the 30 billion debt would have come from banks, would have come from investors, would not get payment, right? And they themselves are going to be at risk that they're going to fail themselves, right? Because they don't get payment. So the systemic and the scale of it makes it such a big deal, and more so a big deal in China than it is in Malaysia. So you probably have heard of a news. You'll be thinking, how is this really affecting me? it has a way to affect you given the scale that it is, right? If it's a small mom and pops or Singapore companies that fail in China, then for sure it's not a big deal for us. But this is a very big company, second largest in China in terms of sales.
Nice. Okay. Another investment question: should I increase my investment exposure in China given the Evergrande's imminent collapse?
Certainly, I think to there are two options here. Like I said, is to maintain it via DCA, like you would have already. And if you are thinking of this for the first time, you can start DCAing now. In fact, it's actually quite good to start DCAing now because you're starting it from a low price.
Yeah.
And if you have a little bit more conviction and you believe what I've said around the e-commerce industry in China, the internet penetration rate that we're seeing, then you want to increase because we're seeing the growth in China still being rapid compared to Malaysia, for example.
Right.
So as a result, your exposure in China would likely to give you better return than what your exposure would be in Malaysia. So you'll be able to effectively, on a total portfolio basis, increase your return with this Chinese exposure.
Cool. Okay. Will there be a domino effect to the US?
Yeah, very good question. And there was some analysis and insights on this. At this point, not yet. Right now, I think there's not going to be any impact, but potentially from those Chinese companies that are listed in China, potentially property development companies, right? That's likely to maybe impact one single or two companies in the US stock market, but it's not likely to have significant economic impact to the US, and not like we've seen with the global financial crisis. Actually, there's a bigger risk in the US, which is the overvaluation of tech companies in the US. So that might be a bigger risk actually that the Evergrande collapse, imminent collapse, right? So to me, the domino effect will not be significant because there's not much lending from US banks to Evergrande. It's mostly actually local Chinese banks, as well as bond investors, which are across the globe, not necessarily just US. So therefore, I don't see this to be significant in the US, given how big US is also as an economy individually, right, within
Right.
the
Yeah.
domestic consumptions and their own GDP size. Right? So to me, this is not likely to affect US significantly.
Cool. All right. So the next question: is there any Sharia China-focused unit trust fund that you would recommend?
There is, in fact, it is one of our one of the three shortlisted unit trust funds is China focused and Sharia compliant. For you to find out, you would need to join our academy, or you need to be a client of ours as one-on-one financial planning services. So I would disclose that when you are already a client. So I hope you can be a client of ours for us to disclose this. Yes, there is, of course, China compliant unit trust funds in China.
Nice. Okay. I have investment exposure in the US, in China, and in Malaysia. How should I change my allocation across these three markets? Well, very specific.
Yeah, maybe because we were talking about China and
Mhm.
the considerations that maybe it is going to affect the US. So in my mind, actually, my personal view is that you should maintain or increase your exposure in China and Malaysia, and maybe tapering off your exposure in the US. Given the high valuation that we're seeing, that it's probably a good time for you to take your profits from your investments in the US, and increasing exposure in Malaysia, because I'm actually quite a big fan of Malaysia now, given how poor our stock performance has been since 2018, right? So KLCI has effectively not moved over the past couple of years. So,
Yep.
and the view from the market is that Malaysia stocks is likely to go on a bull run over the next couple of years. So you might want to increase your exposure into the Malaysia stock market. And I would imagine the
Interesting.
majority of us would already have that exposure. So yeah, that would be
Nice.
what I'll do.
Cool. Okay. So that's next question from our YouTube viewer. Hi, Azril. How to know when the China market will recover? What do we need to look on? So is there any like markers or anything?
Very good question, Arif. So I would look at a couple of well, so there are two parts to it, right? So you can look at it from the data points around the economy, right? Actually, the biggest indicator for any recovery for any stock market it should be the economy, right? So you need to look at the GDP performance, for example. You need to look at the unemployment rate. You need to look at the uh, growth of stock prices. So you would need to look at these broad indicators. Also, at the same time, I actually looked at more technical indicators, right? So, for example, if you look at the chart with stocks, you can look at the component of the moving average of the chart, right? So when it reaches a point where there's intersection between, for example, 90 days to 30 days, you'll be able to see a potential inflection point to the price, right? So these are a combination of indicators that you can look at, and these are so-called leading indicators
Mm.
that would give you an insight of whether the market would recover or not. So a combination of both economic as well as technical charts and indicators to see whether the market will recover.
Nice, nice. That's very good. That's a very good answer. All right, next question. Why is it that the government allowed Evergrande to take up such a big bond exposure? Isn't there like a rating agency that does that?
Yeah, very good question. So I think for this, to answer this, one needs to understand the process that needs to go through before a bond is issued in the market, right? So there is certainly actually a rating agency that goes through the process of reviewing the bonds, right? So and putting a score, just like your exam score, right? They'll say a triple A or triple B, right? So that process is actually undertaken even for Evergrande, right? So that process is rigorous today. So every bond that is raised, you'll be able to see what the level of risk is by looking at their rating, right? Either it's
Right.
above triple B, which is considered as high grade, or lower than triple B, which is called high yield, right? So for sure, Evergrande has actually undertaken this, except that I think the government in the past has taken a rather relaxed approach to taking a big exposure like what Evergrande has done, right, which is at 300 billion. And what we're seeing is actually the government is trying to push them to reduce their debt exposure. So that is more so. In fact, what the government is doing is resulting in further decline. Actually, it further exacerbates that there's going to be that potential failure because they need to taper down that exposure. But what we're
Right.
seeing, and this is interesting over the past couple of days, you'll be able to see is that there's a possibility that there might be a private white knight investors that's going to come in to take over the company. If I'm an investor from a property developer, for example, that wants to have exposure in China, it's a good time for me to actually buy a company like Evergrande with such a big
Right.
access and such a big sales. So if I'm a property developer, say for example in Hong Kong, that have yet to have exposure in China, that wants to have exposure in China, can buy this. And what we're hearing is that there's a potential rumor that there's going to be a big property developer in Hong Kong that is going to be buying Evergrande. So it might be an instance that Evergrande might not even collapse, but we're already
Right.
seeing the decline as a result of people's perception that it might collapse.
Yeah.
So the price is just actually a decline as a result of market irrationality. And for you as a rational investor, you should be taking on this opportunity to buy more of the asset. So that's my view.
Interesting. Interesting. Awesome. Okay. Their yield is at 8%, right? Which means that this is a high risk bond from the start.
Indeed, correct.
8% is very
So
high, right?
so they would be categorized as a junk bond,
Junk bond. Yeah.
effectively. But not necessarily a bad bond per se, but it just means that the yield is high and that you're able to get a higher return, but of course with higher risk. Like any other investments assets, if with higher return that you should expect, then you should also be knowing that there is an element of higher risk that you will be taking from that investment. So yes.
Okay, so the next question is this considered a black swan event? And should I then break my asset allocation rule to take advantage of this? I think you
It's a good
mentioned
question,
something
right?
there. Mhm.
So we talked about asset allocation, and how do you consider your asset allocation by your age? So one of the rules that we a big proponent of is called 100 minus age, right? So if you're 30 years
Mhm.
old, for you to the exposure should be 100 minus 30 or 70% into high growth assets and 30% into stable assets. So this is the common or rule of thumb for your asset allocation. So if you think of this as a black swan event or an event that is out of ordinary, effectively, uh, just by virtue that there's not many black swan among a group of swans, right? Then you should expect that um, that that you'll be able to take advantage from this anomaly, right? And by
Right.
taking and how you take advantage of the anomaly is to increase exposure into a little bit more high risk asset. So with that 70 to 30% allocation, you can increase that 70 to 80, for example, and the additional
Mm.
10 could be specifically for the Chinese market, for example. So yes, if you consider this to be a black event, then you should actually break your allocation a little bit to take a little bit more of risk to give you a higher return over time. So this is again a rule of thumb, right? You could change that and be a little bit more dynamic to it and not be too absorbed into the number, right? Ultimately, can you actually make a higher return from these broad and macro events that we're seeing today?
Right. Yeah. So I think it comes down as well to like your personal risk appetite and whether you're willing to take on more risk for potentially higher returns, right?
That's right. That's right.
Cool. Cool. Okay. Another question from our viewer. With all signals that we have heard, such as the energy crisis, the Evergrande saga, the bond tempering, overpriced tech stocks, will we expect a global stock correction, or even worse, go bust by the end of this year?
Yeah, well, there's a lot of intellectual charlatan, I call it, right, that is in the market today that try to predict whether the market is going to crash this year or next year. The challenge is that with crisis is that it is a crisis because no one can predict it. Otherwise, while there's a small portion of maybe economists that would say that it might fail, but if you have enough people predicting that the economy is going to fail every other month, then for sure someone will get it right?
Yeah.
So that's the challenge. So, but yeah, I mean, there are some certainly signs of potential systemic risk. So Evergrande is one of them. David mentioned energy crisis, for example. Overpriced tech stocks in the US is one example. Overpriced stocks as real ETF investments is also a very interesting one as well. So these can all lead to systemic risk. So the challenge is to identify which of these that would eventually lead to a global crisis. And that might possibly happen, right? So I'm not saying that it might not happen. It will very much happen. Evergrande is not one of them. Looking at the data that we're seeing, but the overpriced tech stock in the US might actually be. So that part is something that needs further analysis on. And if you want to capitalize on this, and if you continue to do DCA, when the price and the correction happens, you would actually buy more, right? Because
Mm.
when it comes to correction, it's often very emotional and very rapid at a very short period of time, right? So when a decline of 50% happen, if you already have an exposure into that stock, and if you think that the crash is going to happen, you could potentially reduce it. So, for example, personally, I'm reducing my exposure in the US market because I think that overpriced tech stocks might lead to significant correction. So that is me trying to time the market. But if you don't believe in timing the market, you can continue to DCA because when the correction happened at 50%, then you're buying more units actually from DCA, right? So yes, we can potentially expect that there is going to be global stock correction, particularly in the US. I see that happening. In China, we've already seen the global corrections. We've seen the stock price going down by 40%, for example, on tech stocks. So actually, there's not going to be
Mhm.
much correction anymore with that decline, right? So maybe the US, and maybe that might be systemic. So the challenge is looking at, okay, is it going to affect just one country or is it going to affect multiple countries? Oftentimes, you can't tell that actually.
Yeah.
So for you as an investor, you can continue to be having exposure into these stocks because one, you have diversification benefit. So if US crash, you still have your Malaysia exposure. If China crash, you still have your US exposure, for example, and continue to invest. I think in the long run, actually, if you invest, and there's a lot of studies around this over a 30-year period, you
Yeah.
will still make high return over time. So you shouldn't be too much bothered with this. But if you want to be a bit tactical, you can. But over the long term, if you continue to invest, you would continue to make money over a period of time.
Yeah. So I think the key is that staying disciplined, not letting emotions get in the way, and then just follow that plan from the start, right?
Yeah.
Cool. Okay, I think we have one last question. This is the last questions. My China investments only have tech stocks, which is, I think, a lot of Malaysian investors, right? What is the worst case and the best case scenarios for me?
Mm. Uh, so if it is a basket of tech stocks, and I assume it is because there's a plural component to
Yeah,
stocks, right? So I don't. So the worst case scenario is, well, some of these companies goes past, right? But if you have a well diversified exposure of 20 stocks or 50 stocks, then therefore one failure is not going to affect significantly the rest of your portfolio, right? Unless that is systemic. But oftentimes, one failure would remain one failure, and as a result, you'll be able to continue to uh, get substantial return from the rest of the tech stocks that you have, because tech stocks are by default a growth stocks,
yeah,
because these are high growth earning companies, right? So in the worst case scenario, yes, that might happen, unless and only you have a very small exposure, and that small exposure might mean one or two companies affecting the whole of your assets. So then that could be the worst case scenario. Of course, means that your return might be negative 80% to negative 100%. And of course, the best case scenario would be, actually, this is the worst of what we've seen so far. So if you had an exposure and you top up some more, man, in 10 years time, you're gonna be smiling, right? And jumping around, because your return would have been at twenty
many,
percent
many times. Yeah.
many folds, right? So 10 to 20% is very possible with tech stock over a period of time. So stick on it, and over time you'll be able to enjoy the return that you will get from your tech investments.
Nice, nice. That's a very nice way to, I think, end our discussion. Always nice to have it on a nice, positive note. So, thank you, Azril, for sharing your discussions. I think you share a lot of personal insights as well. For those of you who want to hear more about Azril's point of view about investments, check out Ringer Plus Financial Planner, right? Which is our one-to-one financial planning service, and you will get you can speak to Azril much more on his views, or get personalized a financial plan, right, in terms of like your investments and what are your personal goals, and he will be able to give you even better allocations and strategies that you can then follow, right? So, Azril, thank you so much for joining us this week. I'm sure I'll catch you in another round, maybe when the US stocks crash, like you just said. um,
Yes.
but but yeah, I know, always nice to chat with you. And I'll see everyone else, all of you, next week, same time, same place. Stay safe, everyone.
Stay safe. Bye bye.